Hey there, future millionaires. Have you ever wondered who's really in charge of the economy and how they keep everything running smoothly? Well, let me introduce you to the puppet masters of finance, the central banks. These institutions hold the strings that control the flow of money around the world. And guess what? They have a secret weapon that can turn the economic wheel: interest rates. It's not as complicated as it sounds. So let's dive in and find out how these interest rate changes affect us and the global economy. Imagine you're playing a game where you need to keep a ball in the air. It's not too hard when things are steady. But when unexpected players join in or others leave, you need to adjust your game plan to keep the ball in play. That's kind of like what central banks do with interest rates. Their main goal is to keep the economy on an even keel, avoiding the pitfalls of high unemployment or skyrocketing inflation. In the United States, the Federal Reserve, also known as the Fed, is our central bank. The Fed keeps an eye on the economy, making sure everything stays on track. But how do they do it? Let's start at the beginning. Have you ever borrowed money from a friend or family member? If so, you know there's one thing people like to see before they hand over their cash: interest. Interest is simply the price you pay for borrowing money. It's usually a percentage of the loan. For example, if your pal lends you $100 and charges a 5% interest rate, you'll end up paying back $105. That extra $5 is the interest. Now imagine you're the bank instead of a private individual. That means you've got the power to set interest rates. And when you change those rates, it sends ripples throughout the economy, affecting how much people spend and how much businesses charge. But how does it work exactly? Well, let's break it down. There are two types of interest rates that the central bank can manipulate: the federal funds rate and the discount rate. The federal funds rate is like the base rate of interest that banks charge each other for short-term loans. It's sort of like the starting point for all other interest rates in the economy. Meanwhile, the discount rate is the interest rate that the central bank itself charges commercial banks for loans. Both rates are crucial because they influence the interest rates offered to consumers and businesses. So how do central banks actually set these interest rates? It's a complex process involving lots of data analysis, research, and discussion. Central banks have teams of economists who study everything from inflation and employment numbers to consumer spending and international markets. They meet regularly to discuss the health of the economy and decide whether any changes in interest rates are needed. Once a decision is made, they announce the new interest rates and everyone else follows suit. It's important to note that interest rates aren't set in stone. They can be adjusted as often as every few weeks to ensure the economy stays on track. But why would the central bank want to change interest rates in the first place? Well, there are many reasons. But let's focus on two major factors: inflation and unemployment. When inflation is high, prices are rising rapidly, making everyday items more expensive. To combat this, the central bank may raise interest rates. Higher interest rates mean that people and businesses have to pay more to borrow money. This makes it harder for people to take out loans or buy things on credit. As a result, demand for goods and services goes down, and so do prices. On the other hand, if the economy is slowing down and people are losing their jobs, the central bank might lower interest rates to stimulate borrowing and spending. When interest rates are low, it's easier for people to take out loans and invest in things like stocks or real estate. This can boost the economy and help people keep their jobs. But wait, there's more. Interest rates don't just affect inflation and unemployment, they impact every aspect of the economy. When interest rates rise, businesses face higher costs, which may force them to reduce hiring or even lay off employees. People with adjustable rate mortgages might find themselves paying more each month, potentially leading to foreclosures. Additionally, a strong economy can attract foreign investment, increasing the value of the currency and making imports more expensive. Conversely, when interest rates fall, businesses are more likely to expand, creating jobs and boosting the economy. People with mortgages or loans may find relief in smaller monthly payments, saving them money and improving their financial situation. A weaker economy, though, can lead to job losses and reduced economic output. Plus, low interest rates may discourage foreign investment and devalue the currency, making exports more expensive. Now here's the million-dollar question. How can you make money from this knowledge? While predicting interest rate changes accurately is almost impossible, understanding the trends can help you make smart decisions. If you think interest rates will rise, you may want to lock in a low-rate mortgage now before rates go up. Or if you anticipate a rate cut, consider waiting to refinance until the rates go down. Similarly, if you're planning to borrow money for a new business venture, staying informed about interest rates can help you secure the best possible terms. Plus, following how the central bank manages the economy can teach you a lot about market psychology and decision-making under pressure. But remember, the economy isn't a game. People's lives and livelihoods are affected by every decision the central bank makes, so it's essential to stay informed and make smart choices to secure your financial future. Now let's look at some of the ways interest rates affect you. The most obvious way interest rates affect you is through your wallet. When interest rates are low, it's cheaper to borrow money, so you might take out a loan to buy a new car or a home. You might also put your savings into an interest-bearing account and earn a little bit of money. However, when interest rates are high, borrowing money is more expensive, so you might not be able to afford that new car or home. And the interest you earn on your savings might not be worth the risk. Aside from your wallet, interest rates also affect your job. When interest rates are low, businesses grow and expand, which means they need more workers. This is good news for you if you're looking for a job or a raise. However, when interest rates are high, businesses struggle to make money. They might even close up shop or lay off workers. This could be bad news for you if you're looking for a job or a raise. Finally, interest rates also affect your life in general. When interest rates are low, people feel richer because they have more money to spend. This can lead to more spending and economic growth. However, when interest rates are high, people feel poorer because they have less money to spend. This can lead to less spending and slower economic growth. So, how do you make money from this? Well, the key is to understand how interest rates work and how they affect the economy. If you can predict how the central bank will respond to changes in the economy, you can position yourself to make money from the resulting changes. For example, if you think interest rates are going to rise, you could buy bonds that pay a higher interest rate. Or if you think interest rates are going to fall, you could buy stocks in companies that will benefit from lower interest rates. Of course, this isn't easy to do, but it is possible with practice and research. Now let's take a look at what happens when the central bank gets it wrong. When the central bank raises interest rates too much or lowers them too little or too slowly, it can cause problems in the economy. For example, if the central bank raises interest rates too much, it can cause a recession. This is when the economy starts to shrink and people lose their jobs. On the other hand, if the central bank lowers interest rates too little or too slowly, it can cause inflation to spiral out of control. This is when prices start to rise very quickly and the value of your money starts to decline. So it's important for the central bank to get it right. And they're not alone in this effort. The government and other organizations also work to stabilize the economy and prevent crises. For example, the government might pass laws to help people who have lost their jobs or invest in infrastructure projects to create new jobs. Other organizations, such as the International Monetary Fund, might provide financial assistance to countries whose economies are in trouble. In conclusion, Interest rates are a powerful tool that can make or break an economy. By understanding how they work and how they affect the economy, you can position yourself to take advantage of the opportunities that arise. Whether you're a savvy investor or just someone looking to make smart financial decisions, knowledge is power. So keep learning and stay ahead of the curve. Who knows, you might just be the next Warren Buffett. And hey, if you found this video helpful, why not watch another one? We've got plenty of videos that can help you make money. So click away and happy investing.